Financial Reporting Through the Lens of a Property Casualty Actuary. Part 3, SAP in the U.S., Fundamental Aspects of the Annual Statement. Chapter 7, Statutory Balance Sheet, a Measure of Solvency. As previously noted, the primary focus of statutory accounting is to highlight potential solvency issues, an insurance company's capability to meet its obligations to its policyholders and creditors when due. Consequently, the most important aspect of an insurance company's financial statements to an insurance regulator is the strength of its balance sheet, i.e., the extent to which its admitted assets are sufficient to meet all liabilities. Relevance to actuaries. Solvency and the balance sheet are relevant to the actuary for two primary reasons. First, actuaries traditionally have some responsibility for the loss and loss adjustment expense, LAE, reserves, which represent the majority of the liabilities for property casualty insurance companies. Actuaries may either participate directly in the reserve setting process, or they may assess the reasonableness of the reserves established by company management. Actuaries involved in either of these functions are focused on the liabilities for losses and LAE on the Liabilities, Surplus, and Other Funds page of the annual statement, page 3. Second, actuaries often have a role in determining or assessing the amount of capital that an insurance company requires to support the risks that it has taken through its business operations. In the context of statutory accounting, this would be based on an actuary's understanding of the risk-based capital, RBC, framework to calculate the required capital at a given point in time. See Chapter 19, Risk-Based Capital. More broadly speaking, actuaries may evaluate the surplus needs on other bases, including on an economic basis, which is guided by the insurer meeting some economically defined criteria for solvency. In both of these cases, an actuary who is evaluating an insurance company's capital will need to be familiar with the admitted assets and the liabilities on the balance sheet, pages 2 and 3, as well as the risk characteristics of each of those items. This chapter will provide an overview of the composition of the two main categories in the statutory balance sheet. Assets, page 2, liabilities, surplus, and other funds, page 3. Assets. Assets can be broadly defined as a property, right, or claim arising from past events that has future value. From an individual perspective, we are all accustomed to the concept of owning financial assets, such as stocks and bonds, and owning real estate, real assets, such as a home or vehicle. Insurance companies own various assets in the same way that an individual does, and those assets are summarized on page 2 of the annual statement blank, the balance sheet. Some of these assets are consistent with assets of non-insurance entities, and some are specific to insurance companies. Table 2 summarizes the major assets held by the U.S. property casualty insurance industry as of December 31st, 2018. The first column indicates the numerical label for each item, as presented on page 2 of the annual statement. Only the material line items are shown in this summary. As shown in Table 2, the U.S. property casualty industry held $2.1 trillion of assets as of December 31st, 2018. The statutory balance sheet makes two broad distinctions regarding assets held by insurers: cash and invested assets versus non-invested assets. Assets are categorized by this criterion to identify the proportion of an insurer's asset that is readily convertible to cash. The cash and invested assets are assets that could be readily sold in near term to meet the insurer's liabilities, while the non-invested assets are less liquid. This distinction is in line with the emphasis that statutory accounting places on solvency. Rows 1 through 12 on the assets page include cash and invested assets, while rows 13 through 25 include non-invested assets. Admitted versus non-admitted assets. As shown in Table 2, there are separate columns that depict the amount of assets that are non-admitted. These non-admitted assets, which represent about 3% of total assets, are not recognized by state insurance departments in evaluating the solvency of an insurance company for statutory accounting purposes. The rationale for this exclusion is that those non-admitted assets are not readily convertible for use to meet an insurer's liabilities now or in the future, and thus would not be reasonable to consider in evaluating a company's solvency. In many cases, non-admitted assets are determined by formulae established by the National Association of Insurance Commissioners, NAIC. As shown in Table 2, there are non-admitted assets in the cash and invested assets categories, and the non-invested assets categories, though the proportion of non-admitted assets is much lower for cash and invested assets. Several common examples of non-admitted assets will be discussed in the description of the specific asset classes below, such as certain uncollected and deferred premiums and agents' balances, and net deferred tax assets, which will help to demonstrate this point. Those distinctions aside, it is clear from Table 2 that the largest asset class for the property casualty industry in 2018 was bonds, which represented 49% of the industry's total assets, followed by common stocks, which represented 19% of the industry's total assets. These statistics have remained relatively consistent over the years. While most actuaries will not need to have a deep understanding of each of the asset classes on the balance sheet, it is worthwhile to know a few relevant details on the largest classes to have a fundamental understanding of the balance sheet. Bonds, line 1. Bonds are securities that pay one or more future interest payments according to a fixed schedule. The face value of a bond refers to the amount that is to be paid in the final single payment at the maturity of a bond. When an insurance company purchases a bond, the current value of that bond is recorded as the actual cost, including brokerage and other fees. This purchase price may be more or less than the face value of the bond. To the extent that the purchase price is higher or lower than the face value of the bond, a bond premium, or discount, is recorded as a part of the recorded amount. Over the life of the bond, that bond premium or bond discount will be amortized according to a constant yield approach. The reason for this amortization is that when the bond ultimately matures, the amortized value will be equal to the face value, eliminating a lump sum gain or loss at the maturity of the bond. After the purchase, statutory accounting indicates that bonds be recorded at one of the following bases: amortized cost, or the lower of amortized cost or fair value. The designation that the NAIC's Security Valuation Office, SVO, assigns to the bond determines the applicability of the two bases above. The 6 possible designations are NAIC 1 through NAIC 6, which range from the highest quality bonds to bonds in or near default, respectively. Bonds with the 2 highest designations, NAIC 1 and 2, are carried at amortized cost, while bonds with designation of NAIC 3, medium quality, and below are carried at the lower of amortized cost or fair value. The amount at which a bond is recorded following these criteria is referred to as the adjusted carrying value. Schedule D of the annual statement provides details on the specific bonds that are held by an insurance company, including the following: type of insurer, e.g. federal, state, or corporate; maturity, e.g. 1 year, 1 year to 5 years; NAIC class, class 1 through class 6. Based on the industry aggregate annual statement as of December 31st, 2018, insurance companies' bond portfolios were made up of approximately 44% industrial bonds, 24% special revenue bonds, and 17% U.S. government bonds. By maturity, just over half of bonds held were 5 years to maturity or less, with the majority of the remainder having maturities between 5 and 10 years. Furthermore, approximately 80% of bonds held by insurers were in the NAIC Class 1. Given that bonds are the largest asset class for property casualty insurers, An actuary or other user of the financial statements who is reviewing the financial health of an insurance company may benefit from reviewing the detail in Schedule D. Stocks, lines 2.1 and 2.2. As shown in Table 2, approximately 19% of insurers' assets were in common or preferred stock. Stocks are securities that represent an ownership share in a company. Those ownership shares are subordinate to bondholders and creditors. Common stock ownership confers voting privileges and may pay a dividend, though the dividend is not guaranteed. Preferred stock does not confer voting privileges, but usually provides a guarantee on dividends to be paid, and usually has preference to common stock in the event of liquidation. At purchase, stocks are valued at cost plus any brokerage or related fees. After purchase, publicly traded stocks are recorded at fair value, which is based on the market price that is readily available to the public and which can generally be determined from external pricing services. If a stock is not publicly traded or a price is not available, the NAIC's SVO will determine a fair value. Preferred stocks are assigned similar NAIC designations as bonds with 6 rating levels, which dictate whether they are valued at cost, amortized cost, or fair value based on the NAIC designation. An actuary or other user of the financial statements who is evaluating the financial health of an insurance company should take note of a property and investigate further if an insurance company has a relatively larger portion of their assets in stocks compared to the overall industry. Real estate, line 4. 3 classes of real estate are presented separately on the assets page of the annual statement. Properties occupied by the company, properties held for the production of income, properties held for sale. These classes are relatively self-explanatory, though one detail to be aware of is that if a company and its affiliates occupy less than 50% of a property, it is classified as either a property held for production of income or a property held for sale, as opposed to a property occupied by the company. Properties in the first 2 categories are generally recorded at depreciated cost, while properties that are held for sale are recorded at the lower of depreciated cost, i.e. carrying amount, or fair value less encumbrances and estimated costs to sell the property. Details of a company's real estate transactions and holdings are presented in Schedule A of the annual statement. Cash, cash equivalents, and short-term investments, line 5. This asset class generally includes assets that are immediately convertible to cash. As of December 31st, 2018, these assets represented nearly 5% of insurers' total assets, and approximately 2/3 of these assets were in short-term investments. Cash equivalents must have an original maturity of less than 3 months, and short-term investments must have an original maturity of 1 year or less. In the annual statement, details on cash are provided in Schedule E1, cash equivalents are described in Schedule E2, and short-term investments are found in Schedule DA. Further, a reconciliation is made in the cash flow statement showing cash, cash equivalents, and short-term investments at the beginning of the year, adjusted for the net cash, inflows minus outflows from operations, investments, financing, and miscellaneous sources during the year. The result is the amount of cash, cash equivalents, and short-term investments at the end of the year, which is shown in line 5 of the assets page. Uncollected and deferred premiums and agents balances, lines 15.1 and 15.2. These 2 asset classes represent premiums that have been written but have not yet been received. Although the names of the asset classes refer to agents' balances, or balances due from policies sold by insurance agents as intermediaries between the insurance company and the policyholder, both asset classes may also include uncollected premiums from policies sold directly to policyholders. Uncollected premiums and agents' balances include premiums due on or before the financial statement date, while deferred premiums and agents' balances include premiums due after the financial statement date. Both classes include installment premiums that meet those timing criteria as well. Premiums that are more than 90 days past due from an agent or a direct policyholder are considered non-admitted assets. Furthermore, an insurer may determine that agents' balances that are 90 days or more overdue are unlikely to be collected, or they are impaired. In this event, the insurer should write off the uncollectible balance. These two classes together represented nearly 10% of the industry assets as of December 31st, 2018, highlighting that collectability of these assets is relevant to a company's financial health and a measure of the efficiency of its collections department. An actuary or other user of the financial statements who is reviewing the financial health of an insurer may consider the overall magnitude of a company's uncollected and deferred agents' balances and the percentage of agents' balances that are non-admitted. Either one of these metrics could be benchmarked to the overall industry. A company having a significantly higher portion of its assets in these two classes relative to the industry would warrant further analysis to understand the impact to liquidity. Amounts recoverable from reinsurers, line 16.1. This asset class reflects amounts that are expected to be recovered from a reinsurer on losses and LAE that have been paid by the company, but do not include expected reinsurance recoveries for loss and LAE reserves. The reason that expected recoveries for loss and LAE reserves are not included is that loss and LAE are already reflected net of reinsurance on the balance sheet. Additional detail on expected recoveries for both paid amounts and reserves are included in Schedule F, which will be discussed in detail in Chapter 14, Schedule F. The detail included in Schedule F allows an actuary or other user of the financial statements to assess the quality and collectability of the reinsurance recoverables. Net deferred tax assets, line 18.2. Deferred tax assets, DTAs, represent expected future tax benefits related to amounts previously recorded in the statutory financial statements and not expected to be reflected in the tax return as of the reporting date. They are referred to as net DTAs because they are recorded net of any deferred tax liabilities, DTLs, that exist. Two common sources of DTAs relevant to the actuary are the following: the difference in tax accounting and statutory accounting for loss reserves, the carry forward of net operating losses from previous years. The first source of DTAs is particularly relevant to actuaries. For tax reporting purposes, loss reserves are discounted when determining taxable income. This means that an insurance company is not able to deduct from taxable income the full amount of losses that are incurred during a year. Therefore, assuming loss reserves are growing, a company's income on a tax basis is higher than the company's pre-tax income on a statutory basis in the current year. In the future, as this discounting unwinds, the insurer will get a tax deduction, which will not be recorded in statutory financial statements because it was already recorded in the year the reserves were established. The value of this future deduction, 21% of the deduction, represents the DTAs. This asset can be particularly significant for growing companies. The second source of DTAs of relevance to the actuary, carry forward of net operating losses, occurs when an insurance company has net operating losses in one financial year and expects those losses to offset taxable income in the future, thereby reducing future tax liability. For any DTA, an insurer can only record the portion of the asset that is expected to be realized based on available evidence. Furthermore, the insurer must perform an admissibility test to determine the amount of a DTA that can be considered as an admitted asset. As shown in Table 2, DTAs were one of the largest components of non-admitted assets reported at December 31, 2018, representing $7 billion of the total $54.1 billion in non-admitted assets, or 13%. Receivables from parent, subsidiary, and affiliates. Line 23. Many insurance companies are members of a national or international insurance group, or may be affiliated with other insurance companies that are owned by the same ultimate parent company. These affiliates often share services or resources, such as internal support staff or third-party vendor agreements. In these cases, receivable balances for these services or resources exist between the parties. As shown in Table 2, these receivables accounted for about 1% of assets held by the industry at December 31st, 2018. If an individual company had a significantly larger portion of their assets in the form of receivables, a user of those financial statements may consider investigating further, as those receivables may not be as liquid or available as other asset types. More specifically, the user could attempt to ascertain the specific source of the receivables and the proportion of the receivables that are paid on time. Other non-admitted assets. In addition to the examples of non-admitted assets already mentioned, agents' balances more than 90 days overdue and net DTAs that do not meet the statutory admissibility test, there are other sources of non-admitted assets. Several common examples include amounts held for specific types of bonds, stocks, mortgage loans, or real estate that are in excess of limitations that exist in specific states. Electronic data processing equipment and operating system software in excess of specified limits, i.e., a percentage of adjusted capital and surplus. Non-operating system software. Furniture, fixtures, equipment, and leasehold improvements. Balances due from a broker when a security has been sold, but the proceeds have not been received that are still outstanding more than 15 days after settlement. Funds held or deposited with reinsured companies that exceed the associated liabilities or are held by an insolvent reinsured company. 10% of deductibles recoverable on high deductible insurance policies in excess of collateral specifically held and identifiable on a per policy basis. As previously noted, non-admitted assets only represented about 3% of the total industry assets at December 31, 2018. However, due to their importance when measuring solvency, an actuary should be familiar with the sources of non-admitted assets. If an actuary or other user of the financial statements observes that an insurer has a larger portion of non-admitted assets than the industry average, it may be worthwhile to investigate further to understand the source of those non-admitted assets because they could be indicative of a problem with the business. Liabilities and surplus. A liability is an obligation that the company must fulfill based on past events or transactions, which will require the use of the company's resources. Under the literal definition of solvency, a company must have assets that are at least equal to its liabilities to remain solvent. To be prudent and to comply with RBC requirements, see Chapter 19, Risk-Based Capital, most insurance companies have admitted assets that significantly exceed their liabilities. The amount of this excess of admitted assets over liabilities is generally referred to as surplus. Surplus can be viewed as the equity in the business or as the source of protection to the policyholders. These three amounts follow the relationship shown below. Admitted assets equals liability plus surplus, or equivalently, admitted assets minus liabilities equals surplus. Because the combination of liabilities and surplus are equal to assets, liabilities and surplus are presented on the same page, page 3 of the annual statement. The assets reflected in the relationship above include only admitted assets because statutory accounting principles, SAP, do not allow insurers to take credit for non-admitted assets in surplus. A breakdown of the industry liabilities and surplus amounts, page 3 of the annual statement, by significant account is provided in Table 3 as of December 31, 2018. First, note that the total amount of liabilities and surplus shown in Table 3, $2.025 trillion, is exactly equal to the amount of net admitted assets that were shown in Table 2. This relationship must be true given the fundamental equation of admitted assets equals liabilities plus surplus. The next observation that can be made is that the insurance industry's admitted assets equal 1.6 times its liabilities as of December 31, 2018. On the surface, this suggests that the industry as a whole had sufficient assets to be able to sustain a sizable increase in liabilities or reduction in asset values while still maintaining solvency, due to the current positive difference of assets relative to liabilities. However, this may not be true at the individual company level, and there are also other risks that could affect surplus that are not reflected in either the recorded assets, admitted assets, or liabilities, such as catastrophe risk or liquidity risk. An actuary can benchmark a company's ratio of liabilities to surplus against the current industry average. Further investigation may be warranted if the ratio is significantly higher than that of the industry. A review of the company's RBC would be the next logical step. We can also measure each of the underlying accounts in relation to total liabilities or surplus. Together, loss and LAE reserves, lines 1 and 3, have historically been the largest liability item on a property casualty insurance company's balance sheet. As of December 31, 2018, this item represented over 50% of total industry liabilities. This speaks to the importance of property casualty actuaries to the financial reporting process, because they are often the most suited to evaluate and establish those liabilities. The next largest liability class is unearned premium reserves, which make up approximately 22% of the industry liabilities as of December 31, 2018. Given actuaries' involvement in pricing products, actuaries certainly play a role in this premium account. To the extent the unearned premium is not adequate to cover expected future losses, LAE, and maintenance expenses, additional liabilities need to be recorded. Actuaries often play a key role in that analysis. A brief description of each of the key liabilities and surplus classes is provided below. Loss and loss adjustment expense reserves, lines 1 and 3. The required basis for loss and LAE reserves under SAP is defined by Statement of Statutory Accounting Principles, SSAP 55. Unpaid claims, losses, and loss adjustment expenses. SSAP 55 states that the recorded liabilities for loss and LAE reserves for each line of business and for all lines of business in the aggregate should be based on management's best estimate. Note that this term is not explicitly defined in the accounting guidance. Further, SSAP 55 requires that management consider the variability in the estimate of these liabilities. The standard states that management's best estimate may consider a range of estimates. In the rare instances when no point within the range is considered to be a better estimate than other points within the range, the midpoint of the range should be used. Note that SSAP 55 refers to management's best estimate and not the actuary's best estimate or central estimate. However, management will often rely on an actuary's estimate, in whole or in part, in establishing their own best estimate to be recorded on the balance sheet. Whether or not management relies on an actuary in establishing the recorded reserves, the NAIC Model Law for Property and Casualty Actuarial Opinions, MDL 745, requires that a statement of actuarial opinion be provided that attests to the adequacy of the recorded liabilities. See Chapter 16, Statement of Actuarial Opinion. Significant detail on the loss and LAE reserves is included in Schedule P of the annual statement. Schedule P provides loss and LAE reserves both gross and net, and also breaks down the total reserves by line of business and accident year. Further detail on the data in Schedule P and the potential uses of that data are described in Chapter 15, Schedule P. There are also relevant references to loss and LAE reserves in the notes to financial statements within the annual statement. See Chapter 10, Notes to Financial Statements. Because loss and LAE reserves are often the largest, most variable liability on an insurer's balance sheet, they are of critical importance to the financial health of an insurance company. Reinsurance payable on losses and loss adjustment expenses. Line 2. Reinsurance payable on losses and LAE includes liabilities related to assumed reinsurance contracts and is for loss and LAE that have already been paid by the reinsured. A detailed breakdown of this amount by type of reinsurer, e.g., affiliated, authorized and unauthorized, as well as U.S. and non-U.S., is provided in Schedule F, Part 1, Column 6. Liabilities under assumed reinsurance contracts for loss and LAE that are reserved by the reinsured, but not paid, are included in lines 1 and 3 of the Liabilities, Surplus, and Other Funds page, Loss and LAE Reserves. Other expenses, excluding taxes, licenses, and fees. Line 5. In general, an insurance company's expenses can be separated into two broad categories, LAE and underwriting and investment expenses. Further divisions can be made within each category. The underwriting and investment expense category can be further divided into the following subcategories: commission and brokerage expenses, taxes, licenses, and fees, general and administrative expenses, investment expenses. The other expenses liability item on the balance sheet generally represents incurred but not yet paid expenses from the third and fourth categories listed above. Additional detail on these expenses can be found in the Underwriting and Investment Exhibit, U and IE. Part 3, Expenses, where the unpaid expenses are shown on line 26. Although this exhibit does not provide the breakdown of the unpaid expenses by expense category, the total incurred expenses during the calendar year for these other expenses are included on lines 3 through 18. An additional observation from U and IE Part 3 is that each category of other underwriting expenses is split between Column 1, Loss Adjustment Expenses, Column 2, Other Underwriting Expenses, and Column 3, Investment Expenses. This is based on an allocation that is performed by the company, and that allocation determines whether unpaid amounts in these categories appear on the balance sheet as LAE reserves or as other expenses liabilities. Additional discussion regarding other expenses is provided in Chapter 8, the Statutory Income Statement, Income and Changes to Surplus. Further detail regarding the allocation of expenses by category is also provided in the following chapter, Chapter 18, Insurance and Expense Exhibit. Unearned premiums, line 9. Unearned premium represents a liability related to the unexpired portion of all policies in force. For an individual in-force policy, the total amount of written premium can be separated into earned and unearned portions. In the simplest and most common case, this split is made by the number of coverage days in the total policy period that are expired or unexpired, respectively. This approach is referred to as the daily pro rata method, and is the standard method used for lines such as automobile insurance, homeowners, general liability, or property. Another approach that is sometimes used is called the monthly pro rata method. This method assumes that policies are written evenly over the course of the month. Based on that assumption, 1/24th of the premium written in a given month is expected to earn in that month. Subsequent to that, 1/12th is expected to be earned in the next 11 months, and the remaining 1/24th is earned in the 13th month. This abbreviated method allows for the calculation of the earned premium in each month with less data and calculations. Some specific types of coverage require different approaches to calculating earned premium, e.g., title insurance, financial guarantee, and ocean marine. The unearned premium reserves serves the important purpose of recognizing revenue over the time period the policy is in force. Unearned premium reserves represent an insurer's obligation to provide future coverage and the potential obligation to refund the unexpired portion of the premium to a policyholder in the event that a policy is canceled. While this accrual of unearned premium and the subsequent earning of that premium may appear to be an attempt to match revenues with expenses, this is not the case. Statutory accounting requires that expenses related to the acquisition of an insurance policy be realized as an expense at the time of acquisition. Despite that, the full amount of the written premium is still recorded as an unearned premium reserve at the inception of the policy. This departure from the matching principle that is commonly followed in accounting regimes exists to allow for a more conservative, solvency-focused presentation because it results in lower policyholders' surplus, which is consistent with the objective of SAP. Additional detail of the composition of the unearned premium recorded on page 3, liabilities, surplus, and other funds, on the annual statement can be found on page 7, which is part of the U&IE. Page 7, U&IE Part 1, shows the breakdown of the total unearned premium into the following 4 categories. Amount unearned, running 1 year or less from date of policy. Amount unearned, running more than 1 year from date of policy. Earned but unbilled premiums. Reserve for rate credits and retrospective adjustments based on experience. The first 2 categories above are relatively self-explanatory and separate the unearned premium related to policies with effective periods that are 1 year or less and policies with effective periods that are longer than 1 year. The third category, earned but unbilled premiums, includes estimated adjustments that will occur to the premium on audit-type policies, where the actual amount of premium depends on some exposure measure, such as payroll, and is unknown until the end of the policy period. EBUB premiums are only recorded if they are reasonably estimable in the aggregate. The fourth category represents the expected adjustments that will occur on retrospectively rated policies, where the premium is variable based on the loss experience on the policy. In addition, SAP and GAAP require an insurer to establish a separate premium liability, referred to as a premium deficiency reserve, if the unearned premium reserve for a portion of the business is not sufficient to cover the expected corresponding losses, expenses, and other costs. An actuary, in either a reserving or pricing role, should be aware of the criteria that dictate when a premium deficiency reserve is required, so they can advise management accordingly. Different criteria apply for short duration and long duration contracts. Additional discussion of premium deficiency reserves is included in Chapter 10, Notes to Financial Statements, and Chapter 22, U.S. GAAP, including additional SEC reporting. Ceded reinsurance premiums payable, line 12. Ceded reinsurance premiums payable represent premiums that are owed to reinsurers for ceded reinsurance. This liability is recorded net of any commission retained to cover expenses that were incurred in issuing the reinsured policies. This line item does not include ceded reinsurance that are owed to the reinsurer or other funds that are being held as a deposit by the ceding company as collateral for payment of the reinsurer's obligations under specific terms of the reinsurance treaty, which is reflected in the next item, funds held under reinsurance treaties discussed below. Funds held under reinsurance treaties, line 13. These liabilities relate to funds that are held by a ceding company as collateral from a reinsurer. The funds provide security to the ceding company that the reinsurer will pay losses as they come due. This is particularly common in the case of unauthorized reinsurers, companies not authorized or licensed to do business in the ceding company's state of domicile, because it allows the ceding company to avoid a statutory accounting penalty on the recoverables from the unauthorized reinsurer. This penalty is described in SSAP 62R, which states that a recoverable from an unauthorized reinsurer that is not sufficiently collateralized is a non-admitted asset. As noted above,
This category also included ceded reinsurance premiums that were payable but were held according to the terms of the reinsurance agreement. Provision for reinsurance, line 16. Although the magnitude of this liability category is not large for most insurers, it is worth mentioning because it is unique to statutory accounting. The provision for reinsurance is a statutory liability established for reinsurance recoverables that may not be collectible. The change in this provision is recorded directly to surplus. This penalty applies to all reinsurers that are slow to pay or that are disputing amounts owed to the ceding company, and unauthorized reinsurers that do not meet the collateral requirements of the ceding company's domiciliary state. The actual details of the calculation of the provision for reinsurance are shown in Schedule F, Part 3. Chapter 14, Schedule F, provides the details underlying this calculation. Note that the net loss reserves, net unearned premium, and the amounts recoverable from reinsurers for paid losses on page 2 of the annual statement are net of reinsurance, but are stated without regard for the provision for reinsurance. The provision for reinsurance appears on page 3 and is a direct reduction to surplus and does not affect a company's admitted assets or income. This direct reduction to surplus and other direct reductions to surplus will be discussed in Chapter 8, the Statutory Income Statement, Income and Changes to Surplus. Common Capital Stock, line 30. Common capital stock is a surplus account that is equal to the par value of the common stock issued and outstanding. This account only applies to stock insurance companies and does not exist for mutual insurance companies. Par value is an amount set by the issuer of a stock, the insurer in this case, when the stock is initially offered, that serves as a minimum value for which the stock can be sold in that initial offering. Par value has no relation to the market value of a stock and is often set at a low amount, so this common capital stock is not a material item for most insurers. It is only included here to allow for a complete explanation. Certain state regulators have specific requirements for how the par value of shares is established. A separate similar account is maintained for preferred stock. Gross paid in and contributed surplus, line 34. This account represents amounts received through the sale of stock in excess of the par value for each share. This account also exists only for stock insurers. As shown in Table 3, gross paid in and contributed surplus makes up 26% of the industry surplus, and it is much larger than the common capital stock account. Unassigned funds, line 35. Unassigned funds primarily represent surplus that has been accumulated over time through retained earnings of the business. For mutual companies, all surplus will generally be reflected in the unassigned funds account because none of those funds were received due to the sale of stock. However, there are some cases in which mutual insurance companies have changed their capital structure through the creation of a mutual holding company. In those situations, the insurance companies issue stock to the holding company and will have common capital stock and gross paid in and contributed surplus accounts. Unassigned funds represent 61% of the industry surplus as of December 31, 2018. Summary. This chapter has explained the basic structure of the statutory balance sheet and has introduced some of the more significant and relevant accounts. An actuary's involvement is often primarily focused on the loss and LAE reserves, which are the largest liability on the balance sheet. But it is also important for an actuary to understand the bigger picture of an insurer's balance sheet in order to better assess the overall financial health of an insurance company. In Chapter 13, Overview of Schedules and Their Purpose, we will discuss other schedules in the annual statement that provide details beyond what we have touched upon here. We will also discuss how that additional detail can be used with the contents of the balance sheet to assess the financial health of an insurance company.